You're listening to The Intellectual Investor, episode number 111, Portfolio Construction, Macro, and Chess, interview with Angelo Robles. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Portfolio Construction, Macro, and Chess, interview with Angelo Robles. Vitaliy recently had the pleasure to sit down with Angelo Robles of the Family Office Association. In this interview, Angelo and Vitaliy discuss Vitaliy's approach to portfolio construction, how value investors should think about the macroeconomy, how the stock market during the pandemic reminded Vitaliy of chess, and, of course, Tesla. We hope you enjoy it.
Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Really excited about today. It's titled Meet the Investor, Forbes magazine called The New Benjamin Graham. And if you don't know who Benjamin Graham is, shame on you, the godfather of investing, specifically value investing, and the person who Warren Buffett most looked up to. That should probably say it all. Our featured guest today is Vitaliy Katsenelson, and I'm really excited to have Vitaliy on. As I mentioned to him, and I just cold reached out to him about 2 weeks ago, I've been following him in his newsletter for about 2 or 3 years now. He's absolutely one of my favorite writers, and I'm always interested to how great investors think, how they make decisions, and what they're doing in today's topsy-turvy world. So on that note, Vitaliy, welcome to the show.
It's my pleasure, Angelo. Thank you. And I love how you shame the people right away.
I try. So let's get right to it. What's your process for designing a value-based portfolio? Like ideas, screening, research, analysts, investment committees. Walk us through that process.
So this is how I approach our process. So let me give you some context. Most of our clients are high net worth individuals. A lot of them, I manage all their money. So they are not going to make any more money ever again. So when they come to me, they say, Vitaliy, here's my life savings. Don't screw it up. So when we build a portfolio, I want this portfolio basically withstand anything that global macro economy will throw at it. So what I try to do, I try to build it with basically, and we focus on stocks here. So I try to build full of companies that can withstand anything happening globally. And kind of like maybe one way to put it is full lot of cockroaches, and then the feature of a cockroach, it kind of survives anything. or if you don't like cockroach, maybe like a Twinkie. I've been told Twinkie can survive nuclear holocaust. So anyway, but that's where we start. And basically our process has several phases. We do, there's a search phase, there is a analysis phase. Then if you bought it, then it becomes there is a monitoring phase, and then we sell, then it starts all over again. But that is kind of the sequence we go through.
And how many positions would you on average have in a portfolio?
So it's a good question. So if you and I talked a year ago, I would have said probably 20 to 25 positions. During the pandemic, we increased number of positions. And we did this for a good reason, and I think. During this was the first time in the last 100 years we faced a pandemic. And I felt that there were so many underwater risks that I may not see, I may only see it in hindsight, that we decided, and at the time also, like I'm talking about, especially March, April, May, there were so many opportunities available that I was able to increase number of positions and still without sacrificing much return, but at the same time reducing risk. So now probably we are closer to 35 positions.
Yeah, no, that's interesting. So what I would take a look at that is say, arguably, especially with value investors that sometimes could be more concentrated, by diversifying, you may be dampening returns, but you feel in today's very unique world that you wanted to have more diversity in your holdings to hedge against certain risk and monitor those companies very closely.
Yeah, so I think so normally you would have been right about dampening returns. I felt that during the pandemic, because there was a universal sell-off, I would actually be reducing risk without dampening returns. Let me give you an example. We bought we bought money managers, like investment firms during the pandemic. They were all down 60-70%. So in the past, we would have bought one firm and we would have put 5% position. It would be, let's say, 4 or 5% position. Mm-hmm. We ended up buying 3, but we made them as a 5% position. So we bought them as a basket basically. And our rationale was, if one of these companies has this risk that we didn't think of, that's then it's gonna. Then it's if it blows up, it's not gonna kill us. That was kind of
And people perceive this next question differently, and I don't want to give you any guidance. You'll just answer how you feel is applicable, if any at all. Do you follow what some would describe as a mental model, a specific approach?
I am a huge believer in mental models. Because mental models basically allow you to create these frameworks, mm-hmm. which allow you to analyze or see, deal with complex situations. Like one mental model I know you want to talk about, and so let's talk about it. It's the Fisher random chess stock market. But to me, that is a mental model, right? And that question of diversification fits perfectly into that mental model, right? So let's talk about it. So there's I was born in Russia, so kind of chess is in my kind of DNA, where in Russia, chess is what I would argue hockey is for Canadians or something, I don't know. But so when you think about traditional chess, you basically have 3 phases of the game. You have openings. You have openings. Let me kill my phone. You have openings. You have mid game, and then you have end game. So most chess players, that are serious about chess, spend a lot of time and study openings, because number of possible openings is fairly discrete. There's only so many openings that are out there. So let me just put my phone on do not disturb, so it's nobody calls me again. Okay, I'll do this. All right. So because there are only so many openings out there. So when when you start playing chess, and in the opening section, you spend very little time thinking, because you already thought through all of the scenarios before, right? Now, and then when it comes to mid game, this is where number of possible moves is infinite, almost infinite. So this is where you spend a lot of your energy thinking about it. Okay, now think about what happened. Oh, now let's talk about Fisher random chess for a second. So Bobby Fischer, the world champion, I guess he probably got bored with traditional chess. So he kind of co-created his own version of chess, which was named after him, where the rules are the same except one thing. Every single game, the first file of pieces is randomized. So the queen, instead of being in the middle, may end up being on the left or on the right, or far left or far right. So imagine you look at the board every single game, and the pawns are where they were before, but all the other pieces are in very different locations.
So you can't memorize opening moves.
So you can't memorize opening moves. So if you think about this for a second, so think of openings in the traditional chess as a mental model. Each opening is its own mental model. So you can say, okay, if this guy does this, I'm going to bring my mental model, and that's what I'm going to do. You can't bring your old mental models to the Fisher random chess openings, right? Because you've never seen this before. And I would argue the pandemic was that. The pandemic, because you could not, pandemic basically having mental models was actually a bit dangerous because you never played this game before. What happened, the last pandemic we had was 100 years ago, which was a different world, right? So this is why every single decision I made, I try to make sure that the mental models of the past are not necessarily hurting me, because and so every single move I made in the portfolio, I made sure that the example was like me increasing the number of positions was a defensive move just for that reason. So I use mental models all the time, and I think they are important tools. And Charlie Munger, Warren Buffett's right-hand man, is a huge fan of mental models as well, by the way. So yes.
For sure. And I suppose my next question is also broad, but I'll try to narrow it down a little bit. I'm always interested to know how smart people, which you certainly are, especially as an investor, how you make decisions. And maybe to help out a little bit, do you follow certain macro numbers and factors? And if so, what?
So let me give you my mental model on that. How's that?
It's perfect timing.
Okay. So I think I'm going to use Warren Buffett as an example. So Warren Buffett, a long time ago, said that if he did not know he doesn't care what Federal Reserve will do next 6 months. So I think while the investors got a cue from this, that what happens in the macro environment doesn't matter. Okay, and I think they were wrong, because Warren Buffett at the same time made investments based on a long-term weakening of the dollar. And I remember he even wrote an article for Fortune magazine in the late 90s about this. So what Warren Buffett was saying is that he doesn't pay attention to the short-term macro trends. Okay, so he doesn't care what the next unemployment number is not as important to him as if the big events that's happening that have a landscape changing events that happen in the macro environment. So my analogy would be, so you could be either a weatherman or climatologist. Okay, a weatherman spends a lot of time thinking about tomorrow's weather, but the problem is that consumes a huge amount of energy and it has a very short-term shelf life. Yesterday's weather is irrelevant today. Okay, so at the same time, looking at the big climate changing events, it has things may not necessarily happen today, but may happen in the next 10 years. Those trends are a lot more important. So I would argue you don't want to be a weatherman, but climatologist instead. So that's how I look at macro picture. So I look at I try to find big risks and benefits of what's happening in the global macro, and that's how I apply this to our then I integrate this into our kind of stock selection process.
And it's probably more of a macro expert question, but I want to dig into that a little bit. So do you look at certain factors like the 10-year yield on treasuries? Do you look at the dollar? Do you look at oil? Those would probably be a big three. Even though what you do is specific to value investing in equities, do you still feel that they intertwine?
Yeah, I probably spend the least amount of time thinking about that, especially in the short run. But I am puzzled where the oil is going to be in the long run. So I spend time, I spent time thinking about it, and I've done a lot of that thinking, and I think about it. So I think about where a lot of times I arrive to the conclusion and some things you mentioned, like I don't know, and by the way, that's an important mental model to have, because
it's a great one.
because I think let me give you one example. Are we going to have inflation or deflation going forward? That's one of the questions you probably going to ask me, and I'll tell you my answer is going to be I don't know. Okay, and that answer is important. Here's why. If you are a deflationist, if you are certain that we're going to have deflation, you're going to structure your portfolio in a certain way. If you're an inflationist, you're going to do it, you're going to do it differently. If you are a deflationist and you're wrong, you're going to blow up. And so if you are an inflationist, it's almost like my analogy would be the worst thing that could ever happen to you as a poker player when you have a second best hand. Because when you second best hand, you are sure you're going to be right. You're going to win, right? And you're going to go all in, and then your card is second best, and there is no second best, and you lose. So therefore, a lot of times, what's going to happen is I'm going to spend a lot of time doing an analysis, and I'll come to the I don't know solution. I don't know conclusion, and then I'm going to structure portfolio accordingly. That if either scenario plays out, I'm going to come out okay. And that's how I look at it, and that's basically how I look at a lot of macro questions.
Excellent. What is value investing to you? What does that mean?
So I think value investing is misunderstood. What value investing is. So most people read Benjamin Graham's Intelligent Investor and basically arrive to a conclusion that value investing is buying cheap stocks, statistically cheap stocks. It's almost like my argument would be, it's like it's like reading 10 Commandments, and the only thing getting out of that is how to count to 10, right? When people do this, they miss the bigger picture of what value investing is, what Ben Graham was trying to communicate in the Intelligent Investor. Value investing is basically a philosophical framework or an investing framework where and I'm going to list some of the factors. I call them the 6 commandments of value investing, but it's basically you look at analyzing, you look at stocks, not just pieces of paper or electronic bytes, but as businesses, where the stock market volatility is there to serve you. Where you look at risk not as volatility but as permanent loss of capital. Where every time you make an investment, you make a room that you're not going to be right. That you're not going to be right, so you need margin of safety. So those are by the way, just for your readers, and this is I wrote this, I wrote a huge 20-page paper on this, on the value investing. And if you go to 6commandments.com, you can just download it there. It's
it's great. I read it and was going to bring that up later.
But that's what value investing is to me. It's not about buying stocks at 6 times earnings, because if that's all it needed, then my 7-year-old daughter could do this. Because all you need is first grade math. But it's a lot more than that. And I think most people miss that.
I completely agree. And I hate to pigeonhole it in that definition, PE ratios. We're going to get into some of that a little later. But I do think a good follow-up question from my side is, aren't all truly good investments? Shouldn't they be value investments? Which is why I don't like to pigeonhole it by the term growth or value. That's just me.
I think it's a great point. I just wrote an essay that I haven't published yet, where I go after both growth and value demagogues, because the point I'm stressing in that essay is that growth is part of value. If you look at the formula, if you look at the return for a stock in the long run, if you look at if you just look at price appreciation of any stock, and this is a very simple mathematical formula, the reason stock price goes up in the long run because of 2 reasons, or combination of them: price to earnings expansion and earnings growth. So earnings growth is part of value framework. Okay, so if you look at Microsoft and you say, why did the Microsoft stock did not go anywhere from 2000 to 2015 or something, or 2013, is because its earnings were growing but price to earnings was declining. So, and why did the stock go up a lot from then forward? Because earnings PE stopped declining, started to go up, and earnings growth. So growth is part of value.
Yeah, great point. And I'm going to go back to, my audience knows I do like to ask about games. I'm not quite finished with chess yet. So chess is great. Your Russian heritage, it's ingrained in you, like you said. And Fischer random chess takes away memorizing opening moves. That makes it more realistic. But when it comes to games, chess, you have equal information with your competitor. You are limited in terms of what you could do, whereas poker involves luck, just like real life, and you have incomplete information. I guess the bigger picture I'm getting to is, how do you make decisions with incomplete information, yet you have to?
So that's a great point. So a couple of things. So I love the poker analogy because in poker, your decisions in the short run are completely random. Like there is very little connection between decision and outcome. Okay, because there's a lot of randomness. In the long run, if you have a process where the odds in the process are in your favor, then you will reap the rewards of that process. Though any time in the short run, you may have the best process. You can be making you can make a decision. You can be making right decisions, and it's not going to matter. So that's point number one. Point number two, to answer your question, you're never going to have complete information. And so what you try to do is, this is where the margin of safety comes in to some degree, because the margin of safety is there to protect you for the incomplete information, for where you say, I don't know how this is going to work out, but if this works out horribly, I'm buying stock cheap enough that I'm still going to be okay. So when we analyze companies, we basically come up with a kind of three scenarios: kind of bear case, middle case, and bull case. And what we try to do, we value the company based on a kind of a middle of the road case, but we try to buy it below bear case. So if things don't work out, we don't lose money.
So those are very good points. Yeah. It's a random question, pardon the pun on random Fischer or Fischer random chess. This happens here in the US, probably more so with penny stocks, but this absolutely happens around the world. Let's be honest. Unfortunately, there are frauds out there in public companies. And again, I think it's more common in certain other exchanges. We won't be overly granular and go into detail about that. That's a separate subject. But that also helps to cover your basis, not just looking at the management team, its track record, and getting a feel for your experiences. But again, I go back to, if your exposure is 1 or 2% of the portfolio, it's relatively nominal.
Yeah. So I'm sorry. What's the question though? What's the question?
Do you have some awareness that not every company is going to be 100% direct and honest on the books that are reported, especially certain international companies?
Yes. So for instance, we don't own any companies in China, and I think that's what you're trying to avoid. Yeah,
that would be
but I think that for that reason, for that reason, one way to avoid some of the fraud, not all of it, is for looking for simplicity. When something becomes very complex, that's where you hide your fraud, right? Because it's a lot more difficult to hide, to hide fraud in something that is extremely simple and transparent. So, but I kind of I like to pick problems that require low IQ, because I know that those problems will never outmatch me. So whenever you see a company that's very complex, there's high probability for fraud, and then that's how I try to avoid it.
I think you partially answered my next question, but I'll dive a little deeper. Probably has to do with admitting when you're wrong, having a beginner's mindset, and having multiple talented people that will look at a trade or an investment so you get different opinions. But basically, I mean, you've been successful for a number of years. How do you avoid, it's human nature, certain biases and confirmation bias?
So one of my favorite books is it's about Jesse Livermore.
A legend.
I'm sorry?
He's a legend.
Yeah, yes. And I'm going blank with the name. Something about reminiscences of stock operator, or stock speculator. I forget the, And I remember there was this one phrase that stuck with me. He had and the reason I like this book, because he was a trader, I'm an investor. So why is this book important? Well, I think it's important because it's probably the first book that addresses the behavioral investing, the behavioral aspect of investing or trading, for that matter. It doesn't matter from this perspective. But anyway, in this book, he talked about how he was paralyzed because he was so successful. He had this string of success, and he was afraid that the success is impacting his judgment. And so I try to, I think, in being self-aware and being aware of your biases is extremely, extremely important. And then what I try to do in my process is put this kind of guardrails that would protect me against my own psyche. I'll give you an example. When we decide how much to invest in each company, we have a separate process that basically, which is almost like a very quantitative process that basically helps us to limit position size. So it's because the problem is, when you do investment research, you fall in love with the company and you stop seeing risks, and then your position size may become too big.
Right.
So we have a separate process for position sizing, and therefore, because when the position size is based on two factors, really, based on company's quality and valuation. And for instance, if company has, like when we look at quality, we look at company's management, we look at the balance sheet, we look at competitive advantages, and we have a checklist we go through, and based on this checklist, we determine company's quality. And I know that checklist exists to protect me against myself. And that's how we determine the company's position size. The position size that stock is going to be, is going to have in our portfolio.
A pinch off topic, but I always want to change our perspective and come back to certain things. Whether personal or business, do you journal? Do you practice a gratitude journal? And does it help you realize your emotions and how you make decisions?
So this is first of all, I write about 2 hours a day, every single day. I wake up, depending on the time of the year, but somewhere between 4:30 and 5 o'clock, between 4 and 5 o'clock every day, and I write for about 2 hours a day. So unfortunately, a lot of times that competes with my journaling, but that is something I'm absolutely trying to do. And this is something if I had any, this would be my New Year 2021 resolution to journal more. And I've done this for a while, one mistake I have made. I've been journaling right before the pandemic, and during the pandemic, because I started to work crazy hours and it's just disrupted my normal rhythm, I stopped journaling, and I wish I did, because I would like to go back to April 5th or whatever that,
right.
And to see what I was thinking. So this is one of those things where I'm a hypocrite, because I think everybody should journal, including myself. But yeah, I think this is one of the things I'm gonna start doing in 2021 again.
I mean, you're probably going to say because the math or numbers don't make sense anymore, but I would like to dig into that. But the broader question is, what would cause you to change your mind on a given position? You may be very bullish and then change your mind, or very bearish and change your mind. What do you look at? What are key factors that you follow?
Well, that's actually when you buy a company, we have a set of assumptions, and then as time goes by, those set of assumptions get violated, get changed, and then we start to question, and then the fair, we have a certain value for the fair value, and as we question the fair value, then we will change our mind.
Yeah, no, that's true. And that's looking at, your charting and your numbers and that does bring my next question. When I talk to amazing investors, probably the two most common answers I hear, what would you do to train someone to be a great investor? Or what are the two core factors? By far, the most common I hear are discipline and understanding human behavior and psychology. What would it be to you?
I think that person, number one, has to have this burning desire to be an investor. It's not like, I see people in my industry that they come into this industry because of money, but they might have been, they would be doing something else, they could be doing something else. And I think, I forget the name of the guy, but he was this basketball coach who said, you can't teach height in basketball. And I think in investing, if somebody has a passion, like when you're an investor, you compete against other people who are like people like Warren Buffett, who spend 15 hours a day dedicated to that. Not because he had a huge desire to be rich. I think he just loved the game. So I think that love of the game has to be prerequisite. And then discipline, human behavior, all these other factors, you build on top of that, But I think the love of the game is probably number one. In fact, I'll give an example. When we were looking for an analyst for IMA, I set the bar incredibly high. In a sense, somebody to apply, they had to write an essay why I would be making the worst mistake of my life, and I hired them. I asked them to provide me a list of books they read over last year, write about people who had it was a huge laundry list of things they had to do. And I didn't even care to read what they wrote. I mean, it was interesting to read, but to me, it was if person really wanted to work here, if this was not just another place they sent a resume, then that person would go through all the hoops, and because then I would see that the person has kind of the love for the game and would really wants to work for my firm. And that's ended up being the easiest decision I ever made. Hire the person for that, because out of 50 people, I only had to interview 7.
Try to think how I could phrase my next question. I suppose you could say during the pandemic, unlike most of the past 10 years when being passive, I guess net of taxes and fees for many's worked well, now appears to be more of an active quote unquote pickers market. But I look at the S&P 500, there's a lot of companies not doing well. Obviously, why would I want to buy into a basket where a lot, not a couple, a lot of companies aren't doing well? But I guess the converse of that, and this must be a challenge for a value investor, look at what's doing well. There are high-tech, growth-centric companies, the FANG, Microsoft, Tesla. Is this a good or a bad time? And again, I hate to pigeonhole the word value, because you may look at a growth company and look at it differently than simply bifurcating it growth and value.
Yeah, it's a very good question. If you look at the kind of overall market today, the kind of the economy, the dispersion of valuation, and I'm going to use these words carefully, between slow growth companies and fast growth companies. The dispersion between the valuations is basically approaching insanity. Because what happens if the company is growing, then investors are basically saying price doesn't matter. And that's what you see. And this is, and this actually touches on a lot of companies. Like, let's pick Tesla. Let's pick Tesla as an example. I own 2 Tesla cars, and we just bought a second one, and I absolutely love the product. I wrote a tiny book on it, on Tesla, where I basically argued that this company, this is probably one of the most important companies, that developed, the Tesla electric car is probably the second most important product since iPhone. The iPhone would be number 1. And the reason it is important because Tesla accelerated the future. It's basically brought an electric car to us, which would have come eventually, probably 10, 20 years sooner. And I think this is very good for society. However, the Tesla stock went up 8 or 10-fold, depends when you look. And even though, and basically, if you look at Tesla's valuation, it basically assumes that time has no value. Let me explain what I mean by this. In Star Trek, there is this concept of, and I'm going, when you go, when you had a spaceship going from one quadrant to another.
Was it like warp speed?
No, not warp speed. I'm going blank on the name, but basically, when the space folds and you're able to go from one quadrant to another, and suddenly, so that's I'm going blank on the name now. But anyway, so basically, if investors looking at Tesla today, for Tesla to go from producing 500,000 cars to 10 million cars would require, first of all, significant amount of time, but hundreds of billions of dollars of investments. And the stock market assuming today that this, that this is going to happen tomorrow, it discounts as the future already happened, and it ignores the cost of company raising hundreds of billions of dollars of money over the long term. So here's my punchline. In 1999, the price of Qualcomm, which was went up 20x, 20-fold. It went from $4 to $80 in the 1 year. And I would argue Qualcomm is one of the best businesses ever. It's a phenomenal business. And Qualcomm was positioned properly right in the epicenter of growth of internet and mobile. Perfect. Okay. Here's the punchline. If you bought Qualcomm in 99, Qualcomm's revenues went up after that 5x. Over the next 15 years, it went up fivefold. But the stock price has, first of all, in 2001, it declined 80%. And then it took you 15 years to come to the level where you were in 1999. I would argue Tesla is not as good of a business as Qualcomm, because Qualcomm just collect, every time you buy a cell phone, Qualcomm makes $5 or $10. They just collect royalty. Qualcomm is a better, less capital-intensive business. And I would argue that today's stock price for companies like Tesla, and there's a lot of those companies in S&P, they're so expensive that it's gonna, that the valuation discounts, discounts years and years of success. And when they are successful, you're still not gonna make money. Yeah.
I mean, those are very interesting points, and I know how you feel about Tesla. And logically, as you're mentioning your example on that, it does make sense. It's just some things are, and yes, I'm long, I guess you could say, in Tesla. It's worked out pretty well the last year. Doesn't mean that will work that way forever. I think Elon Musk is like the most amazing entrepreneur. I'm glad he's in America and doing hopefully great things here and around the world. But I look at Tesla and it's complicated. Of course it is. It's a climate change company to me, an energy company, a tech company. Oh yeah, it happens to also be a car company. Mm-hmm. But yeah, I mean, you look at the PE ratios and the math, and it does leave you scratching your head. But I don't know. And again, I limit my position. So if it goes drastically down, it still makes up a relatively modest part of my portfolio. I just don't know if that's a person or a company that I want to bet against right now. A lot of the short people have gotten crushed doing that.
Oh, actually, so the word I was looking for is wormhole. So they
yes, that's it.
So I would call it the Tesla stock discounts a temporal wormhole, basically, as time doesn't exist. So let's make it clear. Just let me make a few points. First of all, I'm not saying you should be short in Tesla, but I'm using Tesla as an example because Tesla is trading, like looking at price earnings of Tesla is probably irrelevant because but if you look at price to sales for Tesla, it's probably 22, 25 times sales. So, and also the market capitalization of Tesla is greater than all the other companies combined. So there is but and I don't want to make this conversation about Tesla really. What I was trying to make is the point I'm trying to make. There's so many other companies out there because Tesla is just the most visible example that are so incredibly overvalued. So if you buy an S&P 500 index today, or broader market index, you're buying this a basket of these companies that are that basically are tremendously overvalued. And so this is your high growth companies. And the reason it's happening because investors basically, if the company is growing, they don't care how much you're paying for that, for the growth. And I think that's one big issue I see with the market today.
And I was rereading your newsletters prior to interviewing you, and I'm looking back to August of 2020. So things might have changed in your opinion since then, but you made a couple of comments I would like to bring up and get your opinion now. Mm-hmm. You did state, in our portfolio, we own foreign stocks. A weaker dollar means their earnings will go up in US dollar terms. I agree, relative to what looks like the macro, ironically, that we brought up earlier. But if you could expound a little bit, if you got, 32, 33 holdings, and I know we spoke negatively about certain foreign stocks potentially, but what ratio or what percentage is foreign?
So I think probably depends on the client, probably 30 to 40% of the portfolio today is foreign.
Okay, that's a lot.
Yeah. And let me just the foreign the weak dollar comment. I wrote, and I think this the essay you're referring to. I basically the point I was trying to make in the essay is that the US dollar is a reserve currency, and it's a significant privilege to have for a country, privilege and responsibility to have a reserve currency. And the problem is that when you are reserve currency for 50 or 60 years, you start believing that's your God-given right. And you start behaving as if you are so special that no matter what you do, you're still going to be reserve currency. And I think, and in that essay, which was a very sad essay, by the way, I was making the point that it doesn't mean that U.S. will lose reserve currency status anytime soon, but the way we have behaved over the last, you can look at from our politics, but you can also look at the U.S. balance sheet. Most likely will lead to weaker U.S. dollar, and so that's in part why we own foreign stocks, but we also this is where the value is as well. So European companies, a lot of European stocks have not gone anywhere for 10 years, where U.S. stock market went straight up.
And I think also from that same newsletter, apparently I liked it. I'm going to read a little bit of a longer, and this one will take a little more complex to unpack. Gold is hedging us against two scenarios: a weaker US dollar and the debasement of all currencies. The dollar declines, but so do other currencies. Dollar outflows will be looking for homes. Some will flow into euros, British pounds, Swiss francs, and some into gold, an incorruptible asset. I like the statement. If you could unpack that a little bit for us now that it's 4 or 5 months later.
Yeah. So it requires a preface. So if you read my essays from 3, 5, and 10 years ago, I would have said that I would have been very negative on gold. Not negative. Negative is not the right word. I would have been indifferent to gold.
Right.
Okay. So, basically, gold is a story. Currencies are a story in general, right? Because the currencies don't exist in nature. There's no such a thing. It's a story that the U.S. dollar. You learn about U.S. dollar when you go to, when you go with your parents to a store and they take out $5 of the wallet and buy milk. That's a story. That's a story that we are told since we're very little, and we observe it, and that's why we believe in currencies. Gold is a less popular story than currencies in general, like just than traditional currencies, but it's a well accepted one as well. And my argument today would be that, like as I mentioned before, I feel U.S. We abused our privilege of a reserve currency, and there will be price to pay for that. The only problem is every time I say this, I'm asking when you deal with currencies, you have to always follow up with the question, against what? So we behave responsibly, but then you look at across the pond and you look at the European countries, a lot of them are doing worse, or the same or worse. And therefore, at some point, so the gold, it's very difficult to increase supply of gold, and and therefore that scarcity, what may drive, its price when you have basically every country is making promises, every government is making promises to its citizens that it doesn't keep, and that's you're going to have inflation. So let me just, as much time as been talking about this is our 5% position. Our gold is a 5% position through options that we own. And so I'm not even, my commitment to gold from a portfolio construction perspective, we have a 1% position through call options on a GLG. So it's just a hedge. That's all it is.
Of course. I'm going to read a quote from Warren Buffett. Of course, the Warren Buffett. Your goal as an investor should simply be to purchase at a rational price, a part interest in an easily understandable business where earnings are virtually certain. That's a little complicated, to be materially higher 5, 10, and 20 years from now. That is an awesome paragraph, easily understandable, including the companies, but there's important things to consider that some of it we just don't know, mainly technological disruption and business threats.
So, and Warren Buffett would be probably the person who would tell you stay out of gold. And by the way, so I made the case for gold, and what I would argue is that the reason I never touched gold until this year is because you have, like when you and I debate Microsoft stock or any stock for that matter, even Tesla, we can objectively talk about companies' earnings power, etc. So there's a way to value them at least. Because gold, it's a very difficult to value. So that's why until this year I never touched gold. So I just think this year the pandemic has changed the dynamics. When we start, like when in 1 year, like during the financial crisis, I think US has the bailout was $800 billion, and everybody was up in arms. Now we're talking about in trillions of dollars. We're talking about $6 trillion bailout, as if it doesn't matter. So anyway, so that's. I'm not sure if I'm answering your question though.
Well, I mean, I have so many different questions. We should probably, and I want to be mindful of your time. I'm going to check into that now. We're 10 minutes before the top of the hour. Could I have until 10 minutes after the top of the hour, 20 more minutes?
Sure.
Okay. I forgot who said it. It might have been Munger, but it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I'm assuming you agree. Sometimes, how do you know the difference?
Well, I think this is why investing is not a science but an art, right?
For sure.
And I think this is where the judgment comes in. Listen, I think the Buffett has made probably the best definition of high quality company. Imagine when you're analyzing a company that after you buy it, stock market is closed for the next 10 years. Would you still if you comfortably buying this company, not worrying about the next 10 years, then it's a quality company. That's just and I think this attitude is very important. And the reason it's important because in the stock market, this instant liquidity a lot of times turns you from an investor into a gambler. And this attitude that you're going to buy it and then you can't sell it for 10 years, that puts you back in the shoes of a businessman or an investor. Like, in other words, you'd be buying this company as you are not just buying, again, going back to the piece of paper, not as a piece of paper, but a business. So I'm not answering your question. I'm not giving you exactly what does it mean in a precise, discrete terms, quality company, but a quality company would be the one that you would be willing to own for, be comfortable owning for 10 years if you could not sell it.
We mentioned it earlier, the great Benjamin Graham was big on always invest with a margin of safety, and you did pound upon that, rightfully so, about 10, 15 minutes ago. To you, is that simply limiting your portfolio, limiting your what you have of that company in a portfolio? Are there other metrics specifically that you look at for you to provide a margin of safety?
So about 5 years ago, we made a decision, which actually, and that's going to answer your previous question a little bit more, that we only going to buy high quality stocks. And the reason for that, because if you buy a marginal business, the marginal businesses, if you buy a melting ice cube, the melting ice cubes tend to melt faster now than ever before. And so we made a decision that for us, quality is absolute. In other words, if I analyze the company and we find that, say, doesn't meet our threshold of quality, I don't care what the price is, I move forward. I brush it aside. And I think, so you get protected, as an investor, you get protected by several factors. You get protected by margin of safety, but you also get protected by quality. If I own high quality business, then when you go through a pandemic like we're going through today, those businesses will survive just fine. And then also, if companies if you overpaid a little bit for its companies, for the company, if the company is growing earnings, that growth is going to bail you out at some point.
I've been thinking about some of these things for a while, especially during the pandemic. And ironically, just this week, and I'm a big fan of her work, she has been on the show, Lynn Alden, came out with something and some commentary. I want to share it in probably more of a question format to you. If we strip away the high-tech veneer, have we been in a 12-year mild depression here in the US? I ask you that, Vitaliy.
So depression you mean from the stock price performance or from the economic performance?
Probably more from the economic performance. Stripping away the high-tech.
You know what? Actually, I don't know. I got to think about this because
I'll give a little more context because it builds up a little bit of steam. Since 2008, the number of homeless people has skyrocketed. Look at San Francisco. Life expectancy in the US has not increased in the last 7 or 8 years where it has in other countries, often caused by the uptick in deaths of despair. But I think really the bigger one is, and I'm going to read, those of us in the US that work in technology, finance, healthcare, and government, we've done extremely well, while many folks involved in manufacturing and certain other sectors, think what we may call the flyover states here in the US, and we've seen this during the political challenges we've had, they're economically displaced. It's been very, very hard for them. And I think when she made that comment, that basically is the heart of what she was trying to get at. And I would agree with that, as sad as that commentary is.
No, I think that there's a lot of truth to that. I'm not sure, I'm not sure I could label it as depression, but it's definitely the discrepancy between, the dispersion between haves and have-nots have increased. And I think a lot of it has to do with the skill set that is required. And I think it's only going to get worse, right? Because the automation, I don't know, let's go back 40, 50 years. There was a and it's all, like when you look, when you watch old movies, you see this American corporations have these huge rooms, and you have there you always you had hundreds of women who are sitting and typing, and it's always were women. This is so, and then you had Xerox come out with a copy machine, and suddenly all these women became unemployed, right? So the skill of typing, been basically displaced by one copier machine that takes less space than my office here. So I think, yes, so the progress has been extremely disruptive, and manual labor got commoditized much faster than ever before. And yes, the dispersion between haves and have-nots has increased, but I'm not sure how much value I can add there as an investor, really, to just to the discussion.
Yeah, it's a deep question. We could do a full podcast about. I have a couple of more questions left. One of them is going to be a very deep subject that we're probably going to need to limit to, in the essence of time, to 3 or 4 minutes. And I agree with it, and I take it from your writing, talking about effectively the U.S. and China. Some of your comments, what oil is for Saudi Arabia, data is to China. And then in one of your newsletters, you do a very eloquent and deep dive into 5G. I also agree with you on some of your thoughts on semiconductors. So we're going into a complex subject that requires another 1-hour podcast that I want you to cover your opinion in probably just 2 or 3 minutes.
So if you basically the world is breaking up into 2 camps: the kind of Western camp of technology and kind of Chinese-centric camp of technology. And we are entering into the Cold War of technology. And you can see this clearly, right? The US is basically as you quoted me, basically data is becoming more and more important, and an example is more and more important, and companies that control technologies will be able to control data, and therefore you basically going to have both US and Europe together, and China trying to dominate that space. And that creates its own new risks that we haven't seen before. And I think this is where, as an investor in technology stocks or an investor period, you have to be extremely aware of underwater rocks that may potentially exist. It's very, Angela, it's incredibly difficult to summarize a 6-page article in 4 minutes. So I'm struggling here a little bit, but I like, and I'm saying this just because it took me weeks to write that article, but I would go to contrarianedge.com and read that article, because I think it just, I would do disservice to your listeners.
It was probably my favorite of your work this year, so I highly encourage that as well. You do talk a little bit about defensive stocks, and you mentioned some names to potentially look at. And I believe that was also part of the same newsletter, if I'm remembering correctly.
Yeah.
It's always sometimes a sensitive subject for people, but I think it certainly would endear to the audience if you could maybe highlight a company that, to you, whether they're in your portfolio or not, in terms of why you made the decision either in or out of as a value investment, and what is that company?
So let's I'll give you one company, and that falls right perfectly in the defense sector. So we bought a company called Huntington Ingalls. It's a symbol HAI, and it's basically the sole maker of aircraft carriers in the United States, and that they have a duopoly position in making submarines in the United States. So it's them and General Dynamics. So by the way, we own both companies. We own General Dynamics as well. And this is a company where their backlog, they have a backlog. I'm just gonna make up a number. I don't remember it right away from the top of my head, but it's about $45 billion. which is about next 7 or 8 years of revenues.
Mhm.
Okay, so as the world is becoming less safe place, I look at defense companies in general basically they're anti-fragile. Like if the world gets less safe, they benefit from this. And I'm not wishing for the world to become less safe, but the world will do what it does. And so, when we buy this company, we're basically paying 8 or 9 times earnings for a company whose earnings will continue to grow. Google or Facebook or whoever is not going to displace them. And it's basically either monopoly or duopoly.
Mhm.
And that has a customer that's not going to go anywhere, and it has very high recurrence of revenues. That had a great balance sheet, and also at the time, because they made a lot of investments in the factories of previous 7 years, their capital expenditures will decline, and therefore their free cash flow will grow at a faster rate than revenues. So that's kind of like, I can buy them, and if I get for the next 10 years, I don't have to worry about, and I can sleep well at night. So but the reason opportunity was there, and it's still there somewhat, because these kind of companies were inconvenienced by the virus. When you make submarines, it's a lot more difficult to do social distancing when you make them. And so therefore, that business hasn't really changed, but for the duration of the virus, became less profitable. Okay, and therefore, at some point, as the virus is in a rearview mirror, their earnings power will come back to what it was before, and I would argue probably going to be higher because the world is less safer today than it was, than it was before.
That's an excellent analysis, and I would concur. Probably only 2 more questions left. Vitaliy, you're not going to get out of a 1-hour podcast talking about the world, about investing, and then mentioning gold and not having Bitcoin come up. Come on. I do not know your opinion. My audience knows mine. And by the way, although I have some concerns, I'm an advocate. We're not here to debate Bitcoin, but I want to give you the floor, whether it's 30 seconds, 10 seconds, 2 minutes, your opinion about Bitcoin.
I don't know. There are so many, it's one of those things where I almost don't want to have an opinion, because I'm not sure how valuable that is. I know that it's a story, in the context of the framework we talked before about the story, right? Mm-hmm. Just like gold is a story, Bitcoin is a story that is becoming more and more accepted. And what's interesting, so this is the positive side, is that now you can actually buy Bitcoin on PayPal and some other places. The more places you can buy it, the more it's going to get accepted. But that's a positive thing. But the negative ones there are so many too, because is that the cryptocurrency? Because it's not a very good one. I mean, it's in the sense that when I pay with a Visa or MasterCard, Visa can process, some thousands of transactions a second. Bitcoin as a technology is not there. Then is that the future currency, or some other currencies will be the ones? Is it Ethereum? Is it Litecoin, or whatever? So you have to make that decision when you analyzing Bitcoin. So I look at that, and I basically say, if you, and actually I have to agree with Bill Miller on this, where if you take a tiny position of this for its optionality, fine. Just like with our gold position, I committed 1% of the portfolio that had a notional value of 5, and that is my exposure to gold. If you put, basis points of position in Bitcoin,
futures on the CME.
I'm sorry?
You could do futures of Bitcoin on the CME and soon to be Ethereum. That will help the institutional investor.
Yeah, but futures work both ways. So that's,
of course.
So that is basically the extent of my thinking on Bitcoin. So it's a very wishy-washy answer, because it's a wishy-washy thinking. So that's, yeah.
Yeah, that's an honest opinion. And like you said, maybe a tiny percentage for some people, where if it goes all to smoke, it's not going to destroy your portfolio. I have deeper feelings about it, but this is not the forum to discuss that. We've done enough on Bitcoin and more to come. We don't need to make it the core focus of our discussion today. I see amazing art behind you, and I understand from being a fan of yours and reading your newsletters. But for those that may not be familiar, if you could talk a little bit about your dad and the importance of art for you and your family.
My father is taught electrical engineering for 30 years, and since he was 5 or 6 years old, he painted. And when we lived in Russia, painting was his hobby. And when we moved to the United States, he was almost 60 years old, so he couldn't really teach anymore. So he just embraced painting as a full-time, profession. And for a while, he actually made a living, and then he stopped. Not just because he decided that he wants to keep all his art in the family. So the way I look at this is that life is too short if you just focus on investing, and that's why in my newsletters I talk about I wanted the world to see my father's art, so that's why I showcase him in my newsletters. But I also talk about life, and I also talk about classical music because I love it too. So that's how I guess my father's paintings made into my articles and newsletters.
I think it's amazing. They're beautiful, and I've really enjoyed it. And I was going to bring up very briefly music as well. I know that's been very important to you. Mm-hmm. I'm just interested when you're thinking, meditating, analyzing stocks, do you have classical music on in the background?
Yeah, so I have so when I write, I always listen to classical music, and I put my headphones on. And if I'm really stuck, I'm listening to Bach or opera. but I like Spotify, creates this playlists based on your previous.
Yes, they do.
And so a lot of times I listen to this playlist, and this is how I discover new music. And this is why every member of my family has their own Spotify account. And I beg my kids not to use mine, because then I'll be listening to whatever rap my son is listening to.
Yeah, have them set up their own password and use their own.
Yeah.
For those that are interested in learning more about how they could subscribe, which I highly recommend, to your newsletter, or learn more about, from an investing perspective, how they could potentially, with a separately managed account, etc. I'm going to spell your name to the audience. Vitaliy, and last name Katsenelson. Vitaliy, how could they learn more?
So I just realized the beauty of having my first name and last name. Chances of another Vitaliy Katsenelson being around are very low, but good. So Google will give you the right result. If you want to read my articles, and I would encourage you to get them by email, because then you'll get my father's artwork, my personal stories, and everything else in one package. You go to Contrarian Edge, EDGE, contrarianedge.com. You can read my articles there, and you can subscribe to them. We also have a podcast, which is kind of Angelo, it's not as good as your podcast, because
it's better.
it's just really someone else reads my articles to you. And, so if you're driving in the car and you just, you don't have time to read my articles, you can listen to them. And it's investor.fm, like a FM radio. And finally, if you want to learn about my firm, you can go to imausa.com. And so those are probably 3 best places to go to.
And when is your next upcoming book? When is it coming out?
It's coming out sometime late spring, early summer.
And it's called?
You're probably the first person to know the name. Actually, it's going to be called Soul in the Game.
Oh, I love it. Excellent. Well, I highly recommend that people engage and reach out. I love your stuff, and it was a pleasure to have you on today. In concluding, everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO at Family Office Association, a global membership organization dedicated to family offices. We do a tremendous amount of original content. We're extremely active hosting physical events, a little bit more cramped now because of COVID, of course. Although we have done a couple of roundtables very discreetly and very carefully, but we host hundreds of virtual programming, and especially in 2021, lots of variations of it that is going to be very engaging, specifically for our members. I recommend on social media, probably my YouTube is my most interactive, or simply Family Office. Go and subscribe. And to learn more about the company and potentially to become a member, very simply, familyofficeassociation.com. And my direct email is angelo@familyofficeassociation.com. Vitaliy, thank you so much. Our live audience, thank you. Look forward to next time.
Angelo, thank you very much. I really appreciate it. Thank you.
My pleasure. Thank you.
Thank you for listening. This and other investment articles by Vitaliy Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.